I was talking to someone the other day that was in their mid 50s and they were starting to approach retirement age. And it was the same night that the market had dropped by a couple percentage points. And they asked what I thought that they should do. And there was two recommendations that I made at this point. The first was don't sell. The stock market typically goes up. So in a 1 year period, it goes up about 75% of the time. And for periods longer than 1 year, it's even greater than 75%. So if you sell, there's a good chance you're going to miss out on gains. The odds are that the market's going to go up rather than it's going to go down. So the mistake that I see is the market goes down by a couple percentage points, people sell, the market goes back up, and then they rebuy, and then they missed out on the gain from the drop to the top. So they're basically selling low and buying high. That's called the great mistake. The second thing that I would consider is if the drop was significant enough, I would consider buying more shares. Now, the first thing he said back was, well, isn't that market timing? I've always heard market timing doesn't work. I agree 100% that market timing does not work. However, I do believe that the United States stock market is going to continue to hit new highs over time. So I don't think you should come home and if the market goes down by 1/4% or 0.5% or 1%, you should be trying to scrape together money and buy. But if it drops significantly, then I do think that probably is a good time to buy because over the long term, I do believe in the United States economy and I do believe that it will continue to hit new highs. A lot of people think that if they pull their money out of the stock market, that it's making them safer when in all reality, it's actually making them more unsafe because they're just basically locking in lower returns by putting their money into something that doesn't have the high potential that the United States stock market has over the long term.